Today's episode is brought to you by Stream by Mosaic, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free 2-week trial on their website at www.streamrg.com. That's STREAMRG.com using the promo code MicroCap. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 204. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. Special thank you to our sponsors for today's episode, Stream by Mosaic, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free 2-week trial on their website at www.streamrg.com. That's STREAMRG.com using the promo code MicroCap. And to Quarter, whose mission is to change the way that people look at investor relations and create a completely new bridge between companies and stakeholders. Visit your app store of choice to try it out, and that's QUARTR Quarter. We are currently underway with our event, the SNN Network Canada virtual event. Yesterday, we had a great day of keynotes and panels, all of which are now available for replay on the SNN Network YouTube channel. Today and tomorrow, we have 70 Canadian microcap companies giving presentations, and it's free to register. So if you're interested, it's not too late. Go to canada.snn.network and join us. Now, for episode 204 of the Planet MicroCap Podcast, I'm sharing the Planet MicroCap Podcast live episode with guest Dave Barr, CEO and portfolio manager at PenderFund Capital Management. That was broadcast yesterday at the SNN Network Canada virtual event. I've had Dave on the program previously, and he even gave a keynote earlier this year at the January edition of this event. I invited him back on the program to take a look back because for those following closely, microcaps have been crushed in the last little bit here, Canadian microcaps especially. And I thought it would be interesting to chat with someone who's in the trenches to discuss this experience, why this is happening, reflect further on a volatile 2021, and what lies ahead for microcaps in 2022. Thank you again for tuning into episode 204 of the Planet MicroCap Podcast. And please enjoy my conversation with Dave Barr. This episode is brought to you by Stream by Mosaic. You can find them at www.streamrg.com. That's STREAMRG.com. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream was built by Mosaic, and unlike any other transcript libraries, Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.com. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And today's episode is our special SNN Network Canada Virtual Event episode, our Planet MicroCap Podcast Live. It's okay. So it might be pre-recorded, but it's live nonetheless. We got to be alive to have this conversation. So live, right? Okay. Well, joining me for this, sorry, Dave, it's gonna be dumb jokes the whole time. So joining me for this special Q&A, it's actually someone who's been a guest on Planet MicroCap before, but being that this is our Canada Virtual Event special, we wanted to get some more perspective on, kind of recapping 2021, looking ahead at 2022, talking about just the microcap markets in general in Canada. And so, to help me do that right now, as you can see here, joining me is Dave Barr. He's the president, CEO, and portfolio manager at PenderFund Capital Management. Dave, always good to see you, man. Thank you for joining me.
Yeah, thanks for having me back, Bobby. I'm a microcap guy, not a macro cap guy.
You're an everything guy. Come on, man.
That's my bad dad joke of the day. So
that was good, right? So Dave, last time when I had you on Planet MicroCap, we went through your whole strategy and we'll talk a little bit about that as well to refresh some people's memories. But to start off, let's kind of do a little year in review. I'd love to get your impression, from the get-go. What's been some of your main takes when you're looking at the Canadian microcap market for 2021?
Yeah, well, it was a crazy year because we started off and microcaps Q4 of 2020, they started ripping, particularly mid-November to end of December. And I think if you're a microcap manager, you probably had the greatest quarter of your career, and you probably should have retired then and pulled the Peter Lynch. The Q1, it continued into Q1 and right through to kind of mid-late February, microcaps were really strong. But then we started to, we kind of saw risk go off in the market, and it was pretty subtle at first, but this really continued through into the summertime. So I think, in the last kind of 9 months, we've seen a lot of kind of course correction, normalization in the market. I mean, there's still a lot of microcap stocks that have done great at 52-week highs. But you can also pull up your list of things that are off 90, 80, 70, 60, 50% year to date. And, as someone who likes a deal, that's where we like to go fishing.
100%. And a lot of the names, is some of the names that are even presenting here at this event. Listen, it's not a big universe when we're talking about revenue generating non-resource microcaps, which tends to be your bailiwick for the most part, but I mean, has any of this been the result of just poor earnings or just or smaller expectations than expected? I mean, what has that been some of the reasons?
Yeah, a couple interesting points to your question there. I mean, what's caused the kind of the correction in a lot of these companies? And I mean, you never really know, but we've seen risk off in the market. There were very high expectations for companies, and I think particularly when you're looking at technology stocks, I mean, coming out of March 2020, a lot of these things hit inflection points, and all of a sudden people see hypergrowth, and a discounted cash flow model works really well if you plug in that growth rate in perpetuity. But the reality is, we had such a massive hit to the system and stimulus for adopting new forms of technology that growth rate was not going to be sustained. So we've seen growth rates come down, and this isn't just in the microcap space. This is right across the board, all the way up to companies like Peloton and bigger. We're back to kind of steady growth, or more normalized growth, which, a lot of these companies is still 20, 30, 40% year over year. But now they're growing off a much higher base because they had this dramatic acceleration over the last 12 months. But because the rate of growth is declining, that spooks a lot of investors. So I think that's probably caused another little bit of turmoil. But also, I mean, the risk off environment, it changed. It did change last spring.
Got it. So, I prior to our chat today, I asked, for the most up-to-date investor deck and pulling some interesting things from there. You talk about how, when you're looking at the current market environment, how it's been a tale of two markets. Can you explain what you mean by that?
Yeah. I mean, we're not quite live. So, we had US Thanksgiving last week here, and we had a pretty good sell off at the end of the week with new virus concerns. And, but prior to that, and we had the headline news is NASDAQ at all-time highs, 52-week highs, S&P, Dow, like all these markets are doing incredibly well. But, the market doesn't capture every stock out there. So, what's really interesting is when you're in an environment where everybody thinks stocks are at all-time highs, and yet, you're still finding a ton of opportunities out there where stocks are well off their 52-week highs. And so it's like these types of markets. I mean, do you want to be long an ETF? Do you want to be long the market? Over the long term, probably, but in the short term, you're way better, and definitely long term, you're way better off in individual stocks right now, because you can actually like high grade your portfolio just by identifying mispriced opportunities out there. And there's no better place to find mispriced opportunities than the microcap space.
I mean, so in terms of mispriced opportunities, I mean, in what sectors in particular, and is this just in Canada really that you're seeing that? Or, I mean, is this also, I don't know how, I mean, you don't look too much, I think, at US stuff, but I mean, in Canada, so let's just stick to Canada. I mean, it's literally across the board. I mean, or is this certain sectors in particular?
No, it's mostly kind of like anything that caught like the COVID benefit trade. So a lot of technology, healthcare, stocks in particular have been hit really hard. And this is not acute to Canada. It's in the US as well. I mean, my partner, Felix, he's, follower of Stitch Fix, Zillow, Peloton, a couple other names. And those things are all off 50% plus year to date. And we've got no shortage of stocks that are off 50% or more year to date in the US as well as Canada. So it's, when we talk about the tale of two markets, we've got the haves out there, and there's always a cool name for it, and it changes because all of a sudden we got a Meta, but you got Amazon, Microsoft, Google, Apple really driving the high end of the market, and those are great companies, and I think some of those we can make a good case they're cheap, but when the outside of those there's a lot of companies which are not trading near their highs, and it makes it for interesting stock picking times.
Absolutely. So you also mentioned in the same investor deck about how it's been a robust M&A market. So let's talk about. Listen, when it comes to Canada, I've joked with you, Paul Andreola, with the whole team, everybody who's a homie up there, just like they need to rename the national logo or the national slogan as the land of the roll up. So this has been nothing new to me in terms of M&A in Canada. Like, oh, shocker! Like, so why is it more robust now than maybe it has been in the past?
Yeah, I mean, just globally, M&A is at all-time highs, right across the board. So in terms of dollar value of deals, in terms of quantity of deals, big companies, private equity, everybody is on a shopping spree. Like, and why is that? It's like, well, their credit cards don't charge any interest. Like, money is so cheap right now. And you look at some of these big tech companies, there's so much cash on their balance sheet. They have so much access to credit. They can borrow money at really low rates. So when you got a really low hurdle rate in the first place, the investment bankers can convince you that basically any acquisition is accretive. So, that's on the corporate side. And then, private equity, there's tons of funds that have raised a whackload of money. They also have really easy access to credit. So when you think of like the M&A market, all it is what is the probability of, a willing seller and a willing buyer meeting up and consummating a deal? Well, you got a whole bunch of willing buyers right now who are almost price agnostic. And so they're willing to pay anything. And, if you're a rationally acting seller of a company, you're probably going to take a price that's way too high for your company today. So we're just seeing, because there's so much capital available right now, it's a very robust M&A market. And it's, I think this ties into kind of the question you asked a bit earlier about the Canadian landscape and expectations. I mean, I think what we've seen in North America in the last 12 months is we've seen a lot of activity in the SPAC market. So, SPACs raised a ton of money a year ago. Now every they're all trying to do deals to bring companies public. And there's a lot of IPO activity. In Canada, there's a lot of RTO activity. So there's a ton of companies coming public today, and which is great for all of us who are looking for the next company to invest in, because there's more companies to potentially invest in. But this actually corrects something. When we talk about the M&A environment, I mean, the last 10 years, Canadian tech companies and Canadian companies in general, they've been picked off by bigger US or international players, and it had really hollowed out the opportunity set in Canada. But we're now in an environment where a lot of those opportunities are being replaced. But also with this robust M&A market right now, we probably need the IPO market to pick up even more to keep up. But that makes this a whole bunch of fun.
I'd like to take a quick second to tell you about this episode's sponsor, Quarter. With Quarter, you get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world, straight from your pocket for no cost. Quarter's mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. The first step on this journey is to let you, the user, interact with the company's content while you're listening. Visit your app store of choice and try it out today by searching for Quarter. And that's Quartr. Now back to the show. Oh, 100%. I mean, it's been really fun for you guys. You've had 11 takeouts in 2021. Like, from what I'm reading, that's a record year. I couldn't have predicted that.
No. Yeah. If you fast forward like a year ago, if you would have told me we'd be, had the performance we've had over the last 12 months and 11 takeouts, I would have laughed and said, well, that's our best case scenario. So it's great living in your best case scenario.
I think that's even beyond the best case scenario, right? Like, that's just like 11 takeouts in 1 year. Like, come on.
Yeah. Well, we do when we're looking at microcap companies, we're generally focusing on growth companies. And when the best case scenario, your bull case, we spend a lot of time on it because, to your point, most people underestimate the bull case scenario. And so it's actually digging in on that and understanding what the real bull case scenario is. Like, the bull case scenario isn't like, your best expectations come to bear. It's better than that. But that's I think that ties into a lot of people who probably sell investments too early, because when companies are doing well, you almost always underestimate the bull case scenario. So yeah, yes, this is probably better than our bull case scenario.
So, I mean, we talked about, you mentioned also here how there's three tailwinds that are driving returns. The first one, we just talked about how this has been a historically robust M&A market. But the other points that you made here is that, small and mid cap catch up trade, the secondary tech catch up trade, and then tax loss selling, creating opportunities. I mean, is this really that different than in other environments before? December is always tax loss selling time, just sticking to that point in particular. I mean, how is this time really so different than other Decembers?
Well, it's different this time is obviously very dangerous words in investing.
Yeah, right.
But yeah, when to your first point, is like, we talk about a small cap to large cap catch up trade. And I mean, I think what we've seen is, if you kind of look at the headline numbers on the Russell 2000, and you compare it to the S&P 500, I mean, we've got small cap stocks trading at the lowest relative valuation they have to large cap stocks since 2003. And if you bought, pretty much 90% of small cap funds that were focused on real businesses back in 2003, you had a great 5-year track record come 2008. On a relative basis, this is, we're way closer to the bottom of small caps compared to large caps than we have been in the last 20 years. And then doesn't mean things can't get cheaper or the dislocation can't continue, but that's where we're at today. On the tax loss side, I mean, I think what we are experiencing right now is, we've got, with how strong markets have rallied out of March 2020, we're seeing a lot of people with capital gains on the table and a lot of people trying to protect those capital gains. And so that actually creates two incentives. Incentive number one is don't sell anything right now where you could trigger a capital gain. And the second incentive is to sell some losers to try and offset your capital gains with some capital losses. And I mean, we're not talking rational long-term investing right now. We're just talking people hate paying taxes. I think that's one thing that probably unites most investors is we all hate paying taxes. So we do have this environment right now where we've got people who have big capital gains. They're not selling things that have gone up, and they're trying to offset it by selling stuff that's going down. And we are seeing, I mean, you can kind of see the charts of stocks that are down 50% year to date. I'm pretty sure a lot of those are going to be, if we had this conversation in a week or two, down 60 or 70%.
Absolutely. I mean, sorry, you're going to say?
Yeah. But the flip side is this could make up for a fantastic reversal trade in January. Because there's a whole bunch of people who are probably like sitting there with baked gains on things which are not reasonably priced. And there could be some pretty good selling of those in January and reloading into the cheap names in the first part of the year. So I think this could be when we always kind of look for catalysts on why stocks could move higher. So I think getting involved in some of these tax loss positions right now, where you like the long-term outlook on the business, not only can you get these businesses cheap today, but they could re-rate pretty quickly in the new year.
I mean, where are you seeing that from? I'm not asking you to name names or anything, much to everybody who's listening or watching's chagrin. That's not what we do. But I mean, where are you seeing this for the most part?
Well, I mean, I think you can tune into Sharon's panel and see a couple of those names. But it's really, I mean, a lot because we saw MicroCap rally hard in the first half of the year. I mean, Sangoma, which is a name all your listeners are probably familiar with. I mean, they did a 7-for-1 roll. So it was $35 earlier this year. And, today it's down at $21. So, I mean, I love that business long-term. It's one of our top holdings today. But it's off almost, 40% year to date. And, could that get hit harder in the next couple of weeks? Absolutely. Does that make us want to hold it even more? Absolutely, because we think the opportunity here going forward is incredibly mispriced. Similarly, I mean, you look at Pronto Forms, I think it was $1.50, $1.60 earlier this year and trading about $1.05 today. So 30 to 40% off its 52-week high. It's right across the board. And it's very symptomatic of the fact that Q1 was such a strong quarter for a lot of these companies in the market. And they've all just kind of drifted off and now they're all being targeted because people have sold other things and they're looking for opportunities to protect those capital gains.
This is going to be a really stupid question. And I love asking incredibly stupid questions. In Canada, is there a tax law that you have to pay taxes on even unrealized gains?
No.
Okay. That's what I thought. Because we're talking about tax loss selling, and of course, it's like a broken record every year. You on or someone else talking a little bit more about tax loss selling because it's December, right? I mean, it's funny because I feel like a lot of the folks that are listening in that focus on in this area of investing, Canadian non-resource microcaps, looking at quality for the most part, revenue generating, even near term or profitable. Most of these folks usually, from what I understand, hold through for the long term. And this is all just like, oh, okay, tax loss selling. Like, here's if I have a couple extra bucks to spare, let's see if I can just load up more on a current position, or maybe here's an opportunity finally trading at a price that I feel like is actually of good value. I mean, like I said, are we just being broken records again, or is this mostly just for, the folks that are that short-term mindset as a reminder, like, hey, this is what happens.
Yeah, I mean, I think a lot of people who are at this forum are. We're all wired to be long-term thinkers and hold positions for the long term. But I mean, we're 2% of the investment population. There's 98% of people are playing a way different game than we are. And thank goodness, because that allows us to make money and generate returns, right? So it's the other 98%. I mean, there was a whole bunch of people playing at the casino, online trading in Q1. And a lot of them would have like sold out of positions and triggered big gains. And I think that's a lot more of this behavior is driven by that type of behavior as opposed to people who actually understand the business, want to own it for 5 years. I mean, maybe you trade around your positions a little bit, but you're not making wholesale changes to avoid tax. I mean, the best way of avoiding tax is to just buy something and never sell it.
Yeah, right. I mean, there is, don't get me wrong.
Assuming it goes up, of course.
Right. I mean, don't get me wrong. There is like a decent trade, right? Where let's say it's a holding that you actually like, and maybe it's down big already. You sell out of it right now. Maybe you buy back in a couple, or, once the new year hits, hopefully it didn't really re-rate anytime before that, right? I mean, that's probably a decent trade for some folks that are savvy enough to be following it close enough.
There's probably some nickels to be picked up.
Yeah, for sure. All right. So, I mean, I think we more or less, I mean, is there anything that we missed covering 2021 in terms of Canadian microcaps, or, I don't know, you follow closer than I do.
Yeah, no, I think that, I mean, the key theme was it was really hot to start the year and not so hot to end the year. But the other key theme, I think, is we're now seeing, with the IPO activity and RTO activity we've seen in the last year, we're seeing a lot more quality businesses coming public. I mean, it's now appealing for a tech CEO to have a publicly traded company again. 3 years ago, you heard tech CEOs saying, "Why would I ever go public?" Well, when you're trading at 20 times revenue, it's pretty good to be public. So it's amazing how high valuations can change behavior. But the benefit of that is we now have a lot more companies have gone public, are looking to go public, and that's wonderful for all of us, because it gives us more files to go through and opportunities to find. So I think that's the other key theme we've seen from 2021.
Absolutely. Yeah, I want to talk about that point a little bit, because I mean, I remember I think it was maybe it was definitely pre-pandemic, it was definitely pre-pandemic. I mean, we were starting to see the IPO market starting to heat up a bit, and there was always this existential crisis amongst us microcap folk being like, where's all the new names going to come from? What's going to, especially in the US, that you're starting to see the same names at every event and presenting and all this stuff, but when it came to Canadian microcaps, there always seemed to be, even if it was down a little bit on that year, it always still seemed to be a very healthy IPO market, especially because in microcaps, I think I just talked to Harold Leishman about this actually on the podcast. And we were talking about how, the venture market has always been such a great place to go for small companies, because it's just such a great ecosystem, because of the investor base that's there. They're believers in how the whole system works, the capital available. I mean, it's always kind of been more or less healthy, but it sounds like 2021, it's been healthier than most.
It's absolutely been healthy. I mean, healthier than most. It's as healthy as it's been since probably 1999, 2000 in the non-resource market. So it's been a pretty good run for a lot of these. And the reason is the Canadian, public markets are really set up for small and micro cap companies. I mean, you can be a 30, 40 million market cap company in Canada, and your compliance and regulatory and reporting costs are actually pretty modest for a company of that size. I mean, if you're a US issuer, like $2 million a year, here, go pay your lawyers. I mean, someone's got to make money, so might as well be the lawyers and accountants. But so in Canada, it's a bit more entrepreneurial, and I think that is driven from our history in the resource market, where I mean, it was really it's called the TSX Venture Exchange, because it was really a venture capital market for resource issuers. Let's go raise money and drill some holes and see if we strike some gold. But that's actually translated really well into other industries. So it's really helped the technology market, life sciences, healthcare, right across the board. It's created an environment where you've got a big ecosystem of bankers, analysts, institutional investors, retail investors, all supporting the entire ecosystem, so that it actually does make sense.
It still bugs me to this day. Ever since I had the first like Canadian investing panel, I think I had Chip Maloney, Philippe, Matthew. I don't think was on that one, but who else was on there? I think and Brandon Mackey. It was pretty interesting ever since then, especially when I think of like an incredible investor like Brandon Mackey, right? US guy, solely focused on Canadian microcaps, and that's definitely had a multiplier effect in many respects, but still there's still so many microcap US investors that maybe potentially avoid looking at Canadian microcaps just because they only have a TSX venture listing or a TSX listing or CSE or on the NEO. Like, all right, it makes it more like it's really not that much more difficult. Like, can you talk to that a little bit?
Well, as Warren Buffett says, you only want two things in this world. It's either no competition or an unfair competitive advantage. So yeah, it's just so every US microcap investor, it's way too hard in Canada. Don't even try it. No, I some of my best friends are US hedge fund guys running microcap funds.
That's so funny.
Yeah, sorry.
No, I love that. That was
my
good.
Sarcasm gets the better.
No, that was good. We can't get any other feedback real time here, but you got me cracking up here.
Yeah, like if you're not buying a stock because it's listed on the TSX Venture Exchange, like I don't know, like you've probably got some boss who tells you can't, your CIO or your chief risk officer for some silly reason. And I mean, we see institutional constraints everywhere across the investment world, and this is one of them. But like there is a lot of US microcap managers, hedge fund managers that do look at the Canadian universe. A lot of times, just like it's arbitrage. Because there's way more investors in the US. Stocks trade at much healthier multiples than Canadian companies. I mean, Sangoma's like classic example, trades at a big discount to US peers. That's why they try to US listing is to go access those US investors. So it's a real opportunity for US microcap investors.
Absolutely. All right. So, I want to switch gears then a little bit and, harken back to our first pod that we did a little bit together. Because, for those who may not have known you or know the PenderFund and your strategy there, can you give us a quick overview on your small cap strategy and some of the criteria that you're looking for? I mean, this could be very helpful for those who are in the hunting right now, even maybe at this conference.
Yeah. I mean, the key, so I started in the venture capital space, which, when you're investing in early stage tech companies, you have to know that business incredibly well. Like the level of due diligence you have to get to actually pull a trigger is way different. And it's, in the public markets, you don't have to go as deep necessarily. But what's great in the microcap space is you can use those same tools and you can get an informational advantage. Like you can, just by getting out there and hustling and talking to customers and talking to people at the company, you can get a way better picture of a potential investment than other companies. So for us, like coming from that background, and when we look at the microcap space, when you're finding these companies at 30, 40, 50 million market cap, I mean, the objective is to hold these things until they get to 3 to 5 billion. Like we're looking for 100 baggers, and we've talked about that in the past. So they are available in the microcap space because a lot of times, like in the environment right now, you get mispricings. So they can trade really cheap compared to what the intrinsic value is. So not only do you get the business growth over the next 5 to 10 years, you also get the multiple re-rate. So, something right now, might be trading at 1x revenue, which at scale, a software company can spit out 40% EBITDA margins. So it's like 2.5x EBITDA, right? Trading at 1x revenue. As that company grows, it's going to normalize to 10, 15, 20, even 25, 30 times EBITDA, depending on the growth rate and what that normalized EBITDA would be. So, you can get 10 times multiple expansion on these things. plus you get the growth of the underlying business. And if you get these things that are growing at, in the early stages, 40, 50% is not unreasonable. As you get bigger, it's harder to continue to do so. But, you'd grow your top line, 10 times in 10 years and grow your multiple 10 times. There you go. 100 bagger. It's just that easy, Bobby.
It's that easy. It's that easy. Oh yeah. So, I mean, right now when we're looking at, some of these, potential tax loss selling opportunities, even maybe some of the companies that are presenting at the Canada Virtual. I mean, what are some of the key things that you look for in times like these?
Yeah. So what we always, our process is all about, like, let's make sure we know who the companies are with the management teams we think can execute. So we spend a lot of time talking to management teams, getting a feel for what we think their operational abilities are and their ability to execute. And then we overlay that with, our kind of our industry analysis. So looking at the, how big is the market? Where is this market at in terms of adoption, and what's the competitive landscape? So, whenever you can find one of these companies in the early innings of a big market, and you can stack the odds in your favor by getting them cheap, it's a pretty opportune time to be loading up. And I think with us, a lot of these positions, what you'll see is, when valuations get pretty full, we'll take it down to a 2 or a 3% weighting. When we see attractive opportunities, we take it back up to kind of 5% range. So we like, when there's markets like this, we tend to use this opportunity to trade around and just create a little bit of extra alpha in the portfolio.
Very good. All right. Going back to kind of our first topic here, looking at back 2021, maybe looking ahead 2022, what's some of the main questions that you get from some of your clients when they're calling in and saying, "Hey, Dave, what's going on? What are you thinking? What are we feeling?" I mean, what's been some of the main questions you get?
Yeah, well, this comes back to our first discussion on the tale of two markets, because a lot of people are like, "Hey, how can you buy anything in this market? Everything's crazy expensive." And the reality is, there's a whole bunch of expensive stuff out there. There's an equal amount of cheap stuff out there. So, like Peter Cundall, great Canadian investor, he's one of his famous quotes is, "There's always something to do," and I love that quote because it's particularly relevant in the microcap space. So just like understanding the market dynamics, that's one of the key questions out there. And then people are always wondering about impacts of COVID and whatnot. And I mean, as we found out last week, nobody knows.
Nobody knows. Yeah, I know. We're recording this on Monday, the 29th. And I think we all got that text that late on Thursday night while we were still, unbuttoning our buttons from the turkey, saying new identified Omicron in South Africa. And then, of course, Friday was the 26th, I think was an interesting day, to say the least. So, I mean, looking ahead real quick, don't get me wrong, we're not going to get into a COVID conversation here because we're definitely not qualified to talk COVID. But going into 2022, I mean, what are some of the things that you're looking at? Are there any trends they expect to continue or to fade? Let's go there.
Yeah, I like so going into this year, I think how we moved our portfolios in March 2020 is still very relevant to the market we're in. And when we saw the global pandemic hit, what we saw was a dramatic change in consumer and business behavior, and the whole world went online. And I think now that we're, maybe things are opening up again, maybe they're not, maybe, things are starting to normalize, maybe they're not. But even if things are starting to normalize, I think there is going to be less in-person meetings. There's going to be more people meeting virtually. There will still be a lot of in-person meetings, but the people's behavior, both businesses' behavior and consumers' behavior, has changed. I mean, there's a bunch of people who had never bought groceries online. They bought groceries online when they had to, and I don't think they're ever going back because they hated grocery shopping in the first place. So, what we saw this big shock to the system, and it changed behavior. And so what we're seeing right now is, everybody got really excited about these behavior changes and thought that these growth rates were going to continue forever. But I think what we saw is, it wasn't the slope of the demand curve that changed. I mean, it certainly did short term, but the demand curve just basically structurally shifted up. And so now we're going to get into, the adoption of these new behaviors is going to continue. It's going to be it's still early innings in a lot of this stuff. And it's going to continue for a really long period of time. And what I think we have right now is a really interesting opportunity with security mispricings because of the hype we saw coming out of COVID, the correction we've seen right now, and then we're even layering that off with more pressure on the stocks with tax loss selling. So being super bullish about a year in particular is always a dangerous thing to say. But I look out 5 years and I'm feeling pretty good about where our portfolios are positioned today.
Very good. I wanted to hit on one of the things that you're talking about, how, the virtual versus in-person meetings. Look, we're at a virtual event. There's going to be, hundreds, maybe thousands of meetings taking place over the next couple of days here with management teams and potential investors. You guys interview a ton of management teams. You have many conversations. What's been the PenderFund thought process in terms of, has there been a greater desire to meet in person, or have y'all been perfectly fine saying, we're good, we're good with virtual, or we'll mix it up, or what's been the thought process?
I think we've adjusted really well. We're still not back in the office, and it's given us, particularly being out here in Vancouver. We're not the center of the Canadian universe. So it is harder to get access to companies, but now it's just as easy for a CEO to join us, to do a Zoom meeting, as it is to fly. Or it's way easier for a CEO to join a Zoom meeting than fly across the country to meet us. So we're actually probably getting more conversations going with management teams than we have historically.
Yeah, because it's interesting. Look, we're going to be doing an in-person event in May next year. This is going to be actually our last virtual until we do that next meeting. Because we've been hearing from investors sometimes too, just being like they love the virtual. They know that they're getting so much more access as a result, and they don't have to leave their bedroom to do that. But at the same time, you have your other cohort of audience members and investors that come to all of our stuff that are saying, we want to network. We want to, we tend to get most of our differential insights by meeting in person, like sometimes with the virtual. So, at least for you, do you feel that same way, or are you finding new ways in which to find differential insights as a result of doing, things having to go virtual?
Yeah, I find you can, information flow is improved. What's hard, what you can't replicate online is trust or creativity. That's kind of, where you have the random conversation with someone, and they mention something about another company, which all of a sudden, you connect a dot on some other company. So the more you you sit down and have a beer with someone and you're talking about different stocks in your portfolios and what you like and what you see, I think it's harder to manufacture those types of conversations online in person is the way to go for those. And I certainly miss those, because some of my best conversations are, chatting with other investors at the end of a conference and just getting to know different companies at a different level.
Because look, at the end of the day, when it comes to management meetings, look, for the most part, they're going to tell you their narrative. Right. They'll answer your questions, especially if you've done your research and whatnot. But at the end of the day, most of that information, that's all for the most part going to be available in the filings. At the end of the day, the numbers usually for the most part bear out in one respect or another.
Yeah, and you're not getting. Yeah, you're generally not. You're not like. It's hard to get useful insights. I think where you can have great conversations is when you start talking about, what CEO's 3 and 5 year strategy is, and, because people will be, they're a lot more forthcoming about things 3 to 5 years out, because it's, they're not going to be held accountable to the next quarter on it, which is what everyone's always afraid of doing. So everyone's very well rehearsed on like quarterly and annual guidance and staying away from the danger points. But when you start talking about, what you're doing to actually get that top line growth 3 years out, that's where you learn the most about the individual company, the management team, but also, competitors and other participants in the field. So a lot of CEOs will drop a tidbit like, oh yeah, these guys are like, they're really tough competitors. If you ever hear a CEO say that about a company, go look at that company right away, and you probably want to buy the stock if you like the industry.
It'd be pretty funny to hear a CEO actually do that. But, I mean, I usually ask about competitive landscape almost in every CEO interview. So they're
and you get
they'll usually say they'll usually say a large cap, right? They won't ever say like somebody that's in like a similar range, Yeah. Sorry, I cut you off in what I was saying, but did you?
Yeah, well, every company has that wonderful slide where it's like, here's our product offering, here's our competitors, and here are our 2 other features and why ours is better.
And those competitors, of course, are in like the 3 billion, 10 million. Well, what about this? What about ABCD coming into right around? Yeah, we don't even who, All right. So I'm going to humble brag for you for a second, if you don't mind. PenderFund just received industry recognition with your 4th Refinitiv Lipper Fund Award. One, congratulations. And secondly, for those who don't know what this means, tell us what the significance of this award.
So someone from Pender clearly sent that over to you. As it was just recognition for 10-year performance on the fund. So it's recognized as the best performing fund in its asset class over the last 10 years. So
listen, if Dave's response just now is any indication, he's a very humble guy. Okay. Yes, someone did send it to me, but look, we got to give recognition where recognition's due, right? It's not often you win awards. Okay. Awards are nice.
Yeah. Yeah, but people are investing with me for the next 10 years, not the last 10 years. So if anything, it lights a bit of a fire to try and outdo the last 10 years. It's a fun standard to try to live up to.
Very cool. All right. Okay. Well, listen, from our team, congratulations. And, again, we hope you get the next one as well.
Thanks, Bobby.
All right. Yeah, of course. All right. So to close this out here, because we're about there, you got a busy week ahead of you. I think you have your big town halls coming up this week. So close this out, give us some closing thoughts, maybe final reflections, looking ahead, make us feel, give us that pump up speech, going into 2022.
Well, I think we're ending the year where we got a whole bunch of great opportunities out there. There's wonderful microcap businesses out there trading at really attractive valuations. And in the microcap space, everybody knows a couple guys who are in microcap club or, have found a company in the early stages, held on, and now people are writing books about them on the internet. And the opportunities for everybody. And there's not many professional investors looking at these companies. And if you're a good business analyst and you do your work, and you buy one of these companies, high growth company at a cheap price, and you hold on, you really do have a great opportunity to do well for you and your family over the next 10, 20, and 40 years. So it's absolutely worth the effort. And if you ever have any questions, if anyone has questions, reach out. I love talking microcap stocks.
That's a great way to end it. Dave, where can everybody go and find more information to contact you, follow you on social media, find more info on PenderFund?
I'm a not frequent poster on Twitter at PenderDave, and our website's www.penderfund.com.
Very good. Well, Dave, thank you so much for joining me here for this. This was awesome. I really do appreciate it. Good luck. Definitely good luck this week. I know you got a lot ahead of you, and stay safe. And I look forward to our next chat.
Thank you, Bobby. I'm looking forward to seeing all the different companies present and finding our next great idea for 2022.
Awesome. Thank you, Dave. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.